for the 40 years, celebrating 40 years of the America's SBDC conference virtually.
Yeah. Today, well, Kurt and I are in person, but we're not there at the conference. So my name is Betsy Levanti. I've been a consultant at the Northland SBDC for about 5 years.
And my name is Kurt Walczak. I've been at the SBDC for, well, I guess I'll say it, 19 years.
And we're up in Northeast Minnesota, so in our little corner of the world, but we've presented this presentation at ASBDC in the past. So, you know, we're excited to do it again virtually in this new format, and hopefully we share some good information.
Right, and we did have another financial workshop that we did just a little bit ago too, and that one's financial projections. So if you're tuning into historical financial analysis, don't forget that there's also financial projections that will help take care of the other piece of the puzzle, so to speak, as well.
Yep, absolutely.
So I think we'll just get started. So historical financial analysis, we're going to see if we can get the PowerPoint to move here. Sometimes we have a little bit of lag time. There we go. So again, we're from the Minnesota SBDC or Northland SBDC. If you need to find our presentations, our spreadsheets afterward, you're going to be able to find them at northlandsbdc.org/templates, and they will be there for you to download anytime you want to. And of course, you're going to be able to watch the workshops, I believe, for 6 months after the recordings and the conference is out as well too. So the password for this spreadsheet is NE MN SBDC. So if you needed to open up the spreadsheet for some reason and change some of the formulas around or add to it or delete from it or whatever you want to do, you can certainly do that as well.
Yep.
So some of our learning objectives today, as we talk about this, is we want you to have the knowledge and skills to do a comprehensive financial analysis. So be able to look at the client and say, this is what we gather from the information that you have, your profit and loss statement, your balance sheet, your cash flow. They tell a story of the business. And it's amazing. It just amazes me, Betsy, how we can look at this and take some of that financial information and tell the story of what's been happening with the business, sometimes without even really talking to the client too much. So
right, and one thing is we get that information from the taxes as many times as we possibly can, because interim financial statements through the client, you know, own bookwork, sometimes they're not as up to date as they should be. But
you mean they're not accurate?
Right? Yeah. The nicely saying they're not accurate. The accountants obviously go in and make year-end adjusting statement, you know, adjustments to their financial statements. So we get them from the taxes, and we encourage you to do that as well. That's our absolute top choice.
Right. So what are we going to do today? Well, we're going to input some data into the template using a real-life client case study and client information. Now, I am using a template that is already, data is already input into it, so you don't have to sit here and watch me type numbers into a spreadsheet. That would be even more boring.
Oh yeah, fat fingering all over the place.
So, but we will tell you how to put the numbers in and where to put them and how it all works. So,
and then you will have a blank one when you download it.
Right.
You know, so you can use the exact same numbers as we use, put them into the spreadsheets and test your ability to enter the information correctly against something that is a known quantity.
So we are going to talk about the analysis of the information that's in there besides how to put it in there. So you'll have a completed analysis and you'll be able to talk to the client and the banker, whoever might need to know this information about what's happening with that business and really how good it looks financially.
Right. It's really helpful for people looking at buying a business to run these 3 years.
Right. Right. Or if you get that client that says, hey, I don't have any cash in my business. Can you help me find some cash? Well, sometimes you just need to look at what they're doing and maybe they need to do it more efficiently or in a different way. And this can help you find that too.
Yeah.
So again, our agenda, we're going to start with an income statement, a balance sheet, cash flow analysis. We'll look at ratios for the industry that's out there. You can gather those from many different places. We're going to look at the working capital cycle and what does that mean for the business and how fast can they really turn that cash. We'll look at the permanent working capital that's available to the business based on these financial statements we're analyzing. we're going to look at something called a break-even analysis. So at what point, how much sales do they need to have zero profit? Now, doesn't that sound like fun? We have a financial gap. We're going to look at what happens if they have the same efficiency or if they improve the efficiency in their finances, or again, maybe collecting accounts receivable or turning their inventory faster, okay? We'll see what happens to cash flow when that happens.
Yeah, but we do think financials are fun, so.
They are, right? What else is there?
Right. It's all about the numbers.
All right, so first of all, we're just gonna go through this short PowerPoint to talk about what we're gonna do, and then we're actually gonna show you and get into the actual data. Obviously, we had planned on doing a physical a lot earlier in the year, and we're doing virtual. So rather than, if we were doing physical, we would go back from the PowerPoint to the actual spreadsheet, but doing this virtually, it just made a lot more sense just to do the PowerPoint first and then just to go straight over to the spreadsheet. So I'll go through some of this. So the income statements in the historical financial analysis, again, we're collecting data. Tax records are always the best. But if you have to use internal financial statements, you can. Just remember, unless it's an S corporation, when you get those tax statements, you're not going to get a balance sheet. If it's a single member LLC or a sole proprietorship, you're not going to get a balance sheet on the tax information. So you might have to gather that from somewhere else.
Well, in the current year, you know, the historical financial is 3 prior years and then a current year, you know, to date.
Right.
And so typically that current year is going to be internal statements no matter what you do.
Right, that's true. Balance sheets, okay, again, same kind of thing here. Income statements, balance sheets. How about the cash flow? So cash flow information is going to be entered for you after you enter the income statement and the balance sheet. The system will automatically start to figure cash flow for you. And then we'll talk about some of the analysis that you can do and taking a look at that. It'll tell you the increase or decrease from year to year, and I'll take a look at the balance sheet accounts to do that. Ratios. Oh, we love ratios. So the ratios basically in here are done for you. Yay! You don't have to get out your calculator. They're all there. And it will actually give you the formulas of how those ratios are done as well. So you don't have to worry about, well, what was that? How does that work? So you can learn from what formulas it takes to do those ratios as well. Where do we get those ratios from? Well, it'll calculate the ones that you're putting in for the actual work, the client data that you're looking at. And then we use an NAICS code to go out and get the ratios for the industry. It seems like throughout the years, we've talked to different SBDCs. Everybody maybe uses something different. We use BizMiner. Some people use RMA. I think I've heard of one called First Data. There's lots of different places to get that ratios. Wherever you get them, there's a spot in our spreadsheet where you can put them in and then compare them to the actual. Okay, the working capital cycle. So this just always gets me jazzed. I like working capital cycle. You know, you can see where I am a little bit of a nerd, but the cash comes in.
Kind of have to be to do this job.
The cash comes in, you're going to purchase things, you're going to purchase raw materials, inventory, you have finished goods, customer gets invoiced, you have receivables, you collect it, and you get your cash, and it goes round and round and round and round. And the faster that goes, the more cash there's going to be in the business. So we actually have a graph that the spreadsheet will put up telling you, and that you can share with your client and or bank about what that working capital cycle looks like for you.
And so, where the days are longer. You know, where you're leaving cash on the table, where somebody else is keeping your cash instead of you. That's the fun part. Putting
dollars to the operating cycle days. So once we have this operating cycle, we'll take a look at that and change that into actual dollars. So we're turning days into dollars, so to speak. We'll take a look at receivables, payables, inventory, accruals, net income, depreciation, amortization, all those fun finance words.
Yeah, all the things that your client says, what? And you say, how long does it take somebody to pay you? Oh, yeah, okay. That makes more sense.
So break-even analysis. This is at the point where you're going to have enough dollars, believe it or not, to make zero profit. And that can be a very valuable thing to know. How many dollars do I need to sell? Do I need to put up there to have zero profit? And then after that, you should be making net income after that point.
Well, and this is a great thing to talk to your client about is can you sell that many things? Can you make that many things, whatever it is, your little widget? Can you make enough in a day, in a week, in a month, in order to hit that point? If they can't, then they're going to need to talk about increasing capacity and things like that. So it's a great spot to do a gut check with your client.
You know, sometimes I talk to clients, they don't realize there's only 24 hours in the day.
They'll just, you know, make the day longer. And,
make the day longer, right?
And that's where you have to talk about, you need to hire more people in order to make that happen. So it's a good spot to really just do a gut check.
So the break-even calculation, if you're all sitting on the edge of your seats wondering what it is, here it is. Fixed cost divided by our contribution margin. So for every dollar increase in fixed costs, how much do my sales have to be to match them? We're going to take a look at that too. So
typically not a one-to-one, although clients seem to think that. So this is a great spot to also just show them, you know, how much costs, how much more revenue you need to bring in. It's a good spot.
Right. How much money do I need? Well, this is where the financial gap kind of comes in. So assuming efficiencies, is the company going to need money, or do they have a surplus of money? And if they need money, how much are they going to need? And when you change the efficiencies around, for instance, how fast you collect your accounts receivable, how many times you turn your inventory in a year, that's actually going to give you more cash. We can take a look at a scenario here, and I've got one lined up in the spreadsheet of a real client that I've been working with over the past few years, and you're going to see 3 years of tax statement of a business or a business that this gentleman was looking at purchasing.
And where he should make some improvements in these efficiencies to do what he wants to do with it instead of how the business is operating right now.
Right.
Yeah.
So how much money do I need? So, you know, shortening your collection period, reducing inventory, stretching your payables are always 3 areas that you can take a look at to increase your cash.
Most of our vendors don't like us to stretch out
the
payables. That's not a place to find cash typically. So
it's maybe during the pandemic, but other than that, no. It usually
they're not a fan of that.
Okay, so the conclusion: the historical template is a tool you can use to help business owners in their financial analysis operation. The spreadsheets will be able to access from our website. Complete the workshop survey. So we are not doing a survey this year because we're virtual. So don't worry about that. We won't be doing that. And our website is northlandsbdc.org/templates. You will be able to download this template from there anytime you want to. We do change it around every once in a while.
As we get improvements and folks suggest things, so yeah.
Right. Or if you need to get a hold of us, there's a number that you can call us at as well. Okay, I think what we're going to do now, if Betsy can share our actual presentation, our spreadsheet.
All right, there we go.
Here we go. So we have client name. So this is client name. In honor of our SBDC confidentiality, obviously we're not going to list any.
Come up with a cool name, like, you know, I don't even know what this is.
Kelly can do it like you did.
Yeah, or Minnesota Manufacturing. I don't know.
Okay, well, you know, just when you came up with that here, this is the first thing you're going to do when you come in. You can put the client's name in here. So what kind of client name should we use?
Right, Minnesota. What do you want to call it? Minnesota. It's what kind of a business is it? What industry?
Minnesota Electrical.
There you go.
Okay. And we'll go back and
so as you can see, when Kurt enters this, if you click on subsequent sheets, that name is at the top here. Yep. Minnesota Electrical populates all the way through when you do that on the first page.
So we start out, so I asked, so this is a gentleman that was going to purchase this business, and we were looking at projections as well, but I said, well, the first thing I'd like to do if you want to purchase this business is I really want to analyze this business. I want to take a look at how it's doing and then tell you what I think or maybe some of the things that you can do, and you're going to get a better idea of how this business operates. And that. And he said, sure, fine. So they sent me 3 years of income tax statements. It was an 1120S or S subchapter S corporation. So I did have profit and loss statements and balance
balance
sheets
sheets,
from the from the tax statement, so that worked very well.
Mhm.
So I put in 19, 18, and 17, and unfortunately this is manual work that you have to do, right? Some of us work with undergraduate research assistants or other
Mhm.
times, and sometimes you can get students to put this work in. I like to do it myself because as I'm putting the information in, I get a good idea of what's happening, so I'm not just looking at it one. So I'm kind of analyzing it as I'm putting it in at the same time. So that's just kind of my way of it.
Yep, you're seeing where things have increased, decreased, what the changes have been as you're entering
Right,
the data.
right.
Yep.
And you can run pro forma income statements and things like that, but with the other tools that we have mixed in here, it doesn't do the same thing.
Mhm.
So we'll come in here and look at this. So if we look at sales in 17, he had 1.5, and 18, pretty much the same thing, not much more. All of a sudden in 19, sales went up to almost $2 million. So they jumped almost $400,000 in sales in a year.
Well, and you can see the sales growth year over year is
Yes.
calculated here. So you can see this was a 26% increase in sales.
Right.
And you can see the gross profit was at 42, 43% in 2017. It went up in 2018, but it's back to about the same, 42% in 2019. So, you know, some of those sorts of things are the things you start to see right off the bat. What's
Right.
gross profit as a percent of sales, and you can start
Right.
tracking some of that. And like Kurt said, if you do it yourself, you can see these things right off the bat.
And one of the things I always look at, if you look at cost of goods sold here, so we went from 57% down to 54, up to 57, almost 58%. So I like to see cost of goods sold really not change more than maybe 2-3% from
Mhm.
year to year. If it changes more than 3%, then that may be an indication that something else is happening. Either prices are going up that they're having to pay, or their labor cost is going up, or something like
And
that.
they're not adjusting their sale to their customer
Yeah.
to account for that.
Yeah.
And that's so, you know, you're paying more to produce the same item.
If they would have had a 45% gross profit in 19, like they did in 18, they would have had 3% more dollars to work with. So it does make a big difference. We get down to some of the operating expenses here, and this is where you're probably going to spend most of your time inputting the data. And I'm sorry, it does get a little tedious.
Mhm.
And your clients' names for their accounts and their chart of accounts are not going to match up with this totally.
Mhm.
You can go into these and you can change them. If I want to change this from accounting to something else, I can just do that in the spreadsheet. And some things you're going to combine and put together that really go in one category, or sometimes
Mhm.
you're going to change a name. I do.
Like Kurt, I think look at line, no, go up a little bit. You changed line 18 to pension and profit sharing.
Yes, I did. Yes, I did. Because that's what
What
they
makes
have.
sense.
Yeah.
That's what
This-
makes sense for this client.
This company, by the way, their employees are union employees,
Mhm.
and they have a really big pension and profit sharing plan that they participate in. So that was different from them, and that's why I changed this. But you can see from year to year there, it's pretty consistent.
Mhm.
And their employees really did not change that much from year to year, even though sales went up. So kind of interesting. Sales went up $400,000, but if you look down here at payroll did not
932.
really go up that much, right? So payroll went up like $10,000.
And
but-
as a percent of sales, it actually decreased year
Yeah.
over year.
Yeah, so maybe one or two things. And so these are some of the questions that you write down, then you ask the client. You say, well, what happened with payroll? Sales went up $400,000, but you didn't hire anybody else. Does that mean that these people were kind of,
Twiddling their thumbs. They had excess capacity at work.
I
That
didn't
might
want to say
actually
that.
be it.
They might
Yeah.
have had excess capacity, right? And now they found out that, hey, we can add $400,000 more in sales, and we don't have to hire anybody more.
Mhm.
So that's kind of a cool thing. So that's the kind of information that you get out of putting this together. If I didn't have last year's or the year before next to that in the sales figure, I wouldn't have maybe known
Would've
that,
never
okay?
known. Yep.
If you look at employee benefits, however, oh my gosh, employee benefits went up $30,000. So there you can see that their benefit package went up. They have a union contract that they negotiate, and maybe that union contract went up, so they had to pay more.
Mhm.
So these are some of the analysis kinds of things that you can get from this.
Well, and it went up in dollar figures, $32,000,
Yeah.
but it only increased by a small percentage of sales.
Right.
So
right.
those are the things that, you know, when you just look at the numbers, $32,000, and you think, wow, that's a lot, but it might not actually be as a percent of sales. So that's why we do both the percentage and the dollar figure, so that you can get the full picture, not just part of it.
And I really try to focus on the things on here that really changed in dollar amount. I mean, you don't need to tell a client, let's say, hey, I'm looking at repairs and maintenance, and oh, last year it was 1,800 and this year is 845. No, that's insignificant. It's no big deal. They got $2 million in sales. So don't focus on the little things. Focus on the bigger numbers, or the ones that change a lot in percentage or dollar amount. So as we're going through here, and I will tell you, here's a hack, okay? If you run out of time, right? We never run out of time as SBDC consultants, and we're trying to see the next client. And I'm looking at all this stuff, and I think my client has a pretty good handle on their chart of accounts or what their operating expenses are. I put in a line here at the bottom called operating expenses, right? So if I wanted to, from those tax statements, I could just put in the total operating expenses down there if I wanted to. Not something I recommend all the time, because sometimes you can see some things in all those little chart of accounts in there, but I've done that in the past. All your ratios will still work and other things. So if you really wanted to do let's say you had 3 years of tax
quick
statements,
and dirty,
you wanted to get it done in a half hour, you could actually do it. Okay.
Well, and you might just pull out, say, employee benefits and payroll, and then everything else goes in operating expenses. It just depends on what they want to focus in on.
Exactly. So we do have another income and expense. So if they sell a car or a vehicle or something like that, they have that here. It was insignificant, but I did put it in other income expense. I don't even remember.
Or you've got a retail business on the bottom, and they have a space on top that they rent out. That rent can go into other income here.
So down below, the system starts to put these numbers together and calculate some things for you. So business funds available to pay the debt service. Wouldn't that be nice to know? So depreciation and amortization automatically come in here, and then the net income. It does have interest here, and that's if interest is being paid to the owner. So that would be a question that you need to ask, or you'd find out on the balance sheet. If that interest is being paid to the owner from an owner note, then that would be cash that is available to pay debt service in the business. There wasn't any here, okay? So these are the dollar amounts that are available to pay the debt service. From there, then we're going to put in some loans from the balance sheet. So I grouped kind of the loans together, some of their current and their long-term, and I put them together on here. So we got 126, 104, 67. So you see that the loans kind of went up. The system automatically calculates a debt service coverage ratio. So you can see that our ratio is 1.55. We like to say 1.25, or what we found in the banks up in our area is they like to see that 1.25 number. So we already know a little bit more about this company. We know that maybe they added some more money in equipment and fixed assets. We know that their debt service coverage ratio is looking pretty good.
Right, they look like they're financeable, or you know, like somebody would lend to them.
The officer salary is going up just a little bit, and that's not a problem. There is a place to put in some owner personal loan payments and things to figure out a global cash flow. I usually, even though this is in the spreadsheet, I usually don't deal with that. I let the bank kind of figure that out, because the bank's going to gather all their personal financial information as well. I just focus on the business. But if you wanted to get a global cash flow ratio, you could ask them and put in some of their personal things as well here if you wanted to gather that.
Right, especially if your banker wants you to do that. Sometimes they want you to, sometimes they don't. They'd rather do it themselves. Either way, you know, one of the things that I do tell my clients right off the bat, and I know Kurt does too, is ask your banker what they're going to want to see. I don't want to do any more work or spend any more time gathering data that the banker's not going to want to see.
Right.
So, you know, it's really important for them to be talking with that lender right up front if they've got one in mind.
Right. Then we move over to the balance sheet portion. So again, I've got the tax statement, and I'm just putting in the balance sheet, and these percentages are based off of the total assets of the company, and you'll see where those come into play later on as well. So at the end of the year in 2019, their tax statement said they actually had a negative 7801 in cash, just at a point in time. Accounts receivable, inventory, and you kind of get, you know, they have a building, but it's fully depreciable, pretty much not much left to depreciate there. We've got some notes payable, some other current liabilities, some accounts payable. That's starting to go up as sales go up. So that's probably the result of the 400,000 increase in sales. We got a bank loan.
That they're paying down. Looks like
They're
they
paying
took
down.
an increase.
Yep.
Took an additional loan in 2018.
They did. They went up and then they went back down. So they're paying that down, even though they had a little bit more that they took out in 18. Retained earnings, so you can see for the 3 years that's going up. Very good.
Which means that they're leaving some money in the company. And so for your client who wanted to purchase this company, means there's something worth purchasing.
Right, right. So far this company is really looks pretty good. So we have a cash flow analysis. What this is doing is giving you the increase or the decrease in receivables, inventory, payables, accruals as you go through this. That's why there's only 2 years, because it's an increase or decrease between 17 and 18, and then between 18 and 19 is what you're seeing here.
So this is the change in position from 1 year to the next.
Right, right. So again, it looks like they're really doing pretty good. I like to go to some of the other sheets. We'll get to the working capital cycle and permanent working capital. I like to look at graphs a little bit more sometimes than the numbers.
But if you scroll all the way down to the bottom of this, you can see at the bottom, sometimes your client doesn't necessarily tell you that they took distributions out of the company. You know, you'll ask, how much are you paying yourself? What's happening in the company? And oh, not too much. My salary's in there. That's about all I'm doing. But here you can see that they took distributions of equity out of the company to the tune of almost, 84,000 between 18 and 19.
Right.
And so it's hard to hide that cash, that cash distribution when you look at this.
Right. They're looking at their retained earnings from year to year and then taking a look at that.
Yep. So that's good information to have.
So ratios. So here we are. So we've got an industry standard that I put in here. So if we look at this, so really we got liquidity at the very top. This is your balance sheet ratios for current, quick, and debt to equity. So the industry standard is 2.34, and holy cats, they're at 3.2 for 2019. Wow, I'm pretty happy with that. They're going, if you look for 17 to 19, they're going in the right direction.
Right, so they have $320 of cash to pay for every dollar of liability.
Right.
Which means they've got enough cash to pay.
So they can, if they needed to liquidate, they could liquidate inventory and receivables and cash and have that to pay back their liabilities.
And you'll notice over on the right-hand side, there's 2 columns for industry NAICS codes. That's because sometimes our clients are not like perfectly in one industry classification.
Right.
Sometimes they'll be in between a couple different ones. And so you really want to look at both industries to see where their improvements might be made in order to increase cash. We like everything to fit really nicely into that, round peg in the round hole, but sometimes it just doesn't work. So we got to look at more than one thing. The quick ratio, again, I couldn't believe it, and I didn't plan on this, but they met the industry standards exactly. Like perfectly.
1.89 to 1.89. I thought, oh boy, this must have been the example I should use because it just matched perfectly. Debt to equity, not quite as good as industry standard, but they're pretty good. Now, bear in mind when you're looking at these industry standards that, yes, it's a benchmark to take a look at and how am I doing? But it doesn't mean that you have to run out and panic and say, oh, the sky is falling if they're a little bit off. Every area of the country is different, every geographical area. We're up here in northern Minnesota and we have more deer in our territory than we have people. So, it takes a lot longer to drive somewhere, to go somewhere, to do things. And so we may not be as efficient as a different company in a different part of our state or a different state. So, well, and sometimes too, our BizMiner data, we can't dial it into just Northeast Minnesota. We're going to have to dial it into the entire state, which takes some larger metropolitan service or statistic areas into account, which, as Kurt says, they have different efficiencies. So one of the things that I always tell my client about this is, we're going to look at the industry standards, but then we're going to talk about why you might be different, and there's a good reason for it. So you're going to always be different from the standard. But looking at these allows you to figure that out, explain it, and be comfortable with it. If you can't explain it and you don't understand why, it's time to dive into that number and figure it out. Right. Good point. So We get down to our gross margin. This is a real critical one. So industry standards 44 and they're at 42. So if they
But
got,
in 2019,
yeah,
they were at industry standard.
they were actually over industry standard in 18. So yeah, that's just one of those things. So then you ask, you say, okay, well, what's going into your cost of goods sold? Are things costing you more? Is labor costing you more? What's happening with that?
Had you bought extra inventory in 2017 that you were able to turn into sales in 2018, and then you know, in 2019 you were buying additional inventory for your next year? You know, how is your cycle on that affecting your margin?
And then you take a look at this net margin, and they are about 3 points below, a little less than 3 points below the industry standard. So what's going on in your operating expenses that are costing you more than most of the other rest of the industry? Is your payroll hired? Do you have too many people hired? Are you paying more for rent or something else, or what is it?
Well, and here's where their pension liability might be coming in and playing a role there.
It could be.
Yeah.
So again, you know, you're going to be able to tell a story, not all the details, complete story, but you're going to ask some really good questions based on the analysis that you do. And then the client's going to think, and they're going to come back with some answers, and then you're going to find out, well, maybe this is okay, maybe it isn't. But
and we've actually run these historical financials and realized the company that the client is looking at is not worth purchasing the way it is.
right.
You know,
Right.
and so they either need to negotiate a different sales price or something. And you know, they can make good decisions based on this.
Right. This one so far looks pretty good. We're getting some good return on investment here, return on assets. Here's the one that's always the kicker, it seems to be, and that's our inventory turns.
Look at that.
And they are, and
they're not doing well with this.
No, they're not. And I actually had a discussion with the client about this, and I said, "Did you know that your inventory turns are only 6?" He said,
they have no idea what that means, but then you can really start.
No, he
That's
actually,
a good conversation
this was a very well-informed client, and he knew that, and he said, I know their inventory has been going up, and we plan on bringing that down. It was so cool. So he already knew, and I was just showing it to him, and he said, yes, I felt that inventory was too high, and we're planning on bringing that down. So
now that's a fun client to work with too, because if they really understand what inventory can do and how that drives.
Yeah, and if we look at collection period, they're a little bit over the industry standard, but still 9 days down from the year before at 49 days instead of 58. Industry standards 43, so they can work on it a little bit more. They have some plans of putting in some more products and increasing sales even more than that 400 that went up from 18 to 19. And so I said, hey, you need to make sure your receivables are at that same days or even less. If your sales are going to grow, where's that cash going to come from to pay for those materials and those direct labor costs until you get paid?
And so that's what's so powerful about these numbers is these ratios tell a story about other aspects of their company, not just the money in their checking account.
Right.
You know, so how is additional inventory, additional staff, additional building space going to affect your cash position overall? What's it going to allow you to do? That's what's powerful about looking at these kinds of numbers.
It is. It is. They didn't have any accruals, so we don't have a number on that one. If we move over to the working capital cycle, and I love this, I love graphs.
This is your sheet. Yeah.
This is my sheet, man. This is it. So 107 days, and how fast that turns is how much cash that company is going to have. It has a direct determinant of how much cash that company has. The less days that you have on this cycle, the more cash they're going to have. So they're at 107 days. From the time they get an estimate to do the work to collect the money, it takes 107 days. And how is that calculated? Well, we take our inventory turns, our turn days, our accounts receivable, and our average collection period, and we throw all that together and we get 107 days. And so you can see here that
well, if you look at these numbers now, yeah, there we go. So inventory turnover is not changing significantly year over year.
Right.
You know, 6, 5, and 6, pretty much the same. Inventory turn days, though, it goes from 56 to 66 and then back down to 57. So there was a 10-day, you know, balloon period there. And then you look at the receivable turnover, again, 8, 6, 7, not significant change, but the average collection period all of a sudden, 44 to 58 days. That's 2 weeks.
Yeah.
You know, when you pull that out and talk to the client about, that's a difference of 2 weeks. Now that's starting to make sense to them in how long that's taking. You know, and for their industry, it might be perfectly fine, but maybe it's not. And so that 2 weeks, you know, that they're leaving the money at their customer instead of collecting it and putting it in their bank account.
Right.
That additional 2 weeks might mean that they can't buy some other customers' inventory to get started.
And some of the things that I've been seeing happening as we talk about the silver tsunami, or people that are getting up there to retirement age and they're looking at selling their company, right?
It's really nice that you have silver hair, so you can talk about this without offending anybody.
So sometimes they just don't put the same amount of effort into the company as they did when they were younger. And the company kind of languishes a little bit. And you talk to somebody that might be purchasing and it says, yeah, I got kind of a vacant owner and it just kind of runs itself. And I've been running into this a lot lately.
Yeah.
And it seems like the new owner wants to come in and they got this, they're going to do this, get this, put some new energy into the company, really, you know, revitalize it again. Where the other owner, it's just not that he didn't care, but they're kind of just doing their thing, kind of sliding out, and they don't realize how the company is starting to get the gravel taken out from underneath their road, because they're just kind of disintegrating and they don't even realize it. So
well, and one thing to mention, one thing to mention too is sometimes we use these historical financial analysis to help a company get ready to sell.
Yeah.
And so when you're doing that, you know, one of the things that we have to tell our clients using this data is, look, you cannot sell it for what it can do. You have to sell the company at the price of what it is doing now.
Correct.
You know, the new buyer can absolutely do this and improve that and change this and bring more cash and, you know, into the cycle. But the current owner can only sell it for what it's really producing right now. So that's one of the things that we do kind of use these numbers to pull that out and show prospective sellers sometimes where they're at. And if they want to make some efficiencies and improvements prior to, they should really look at that, you know, if they want to raise the price on their company.
So let's take a look at the good old PWC, or permanent working capital analysis.
See, this is the one I like.
This is the one you like without the graph.
Well.
So again, we're taking these days and turning it kind of into dollars, right? So if you look again, there's kind of a recap of the operating cycle without the graph. So receivables plus days inventory minus days payable minus days accrual gives our operating cycle there.
So 86 days, that's a little, you know, about 2.5 months.
Yep. Then we get down to our permanent working capital. So we take receivables, add inventory, minus payables, minus accruals. So there is really kind of how much money is available for permanent working capital in that company. That was a good thing. And down below that is the change from year to year. And then if we take a look at our cash flow, we add back in net income, depreciation, amortization. We get a change in working capital. So we have an operating cash flow now of this company in 2019 of $167,000 versus $98,000 in 2018, the year before, isn't it? And sales, and that's a reflection of the sales going up $400,000.
Right.
And they kept pretty close to the same efficiencies with even that increase of $400,000 in sales. So.
And they actually improved things from 18 to 19 again.
Yeah.
So.
So between 17 and 18, they kind of had a downturn. Sales pretty much stayed the same, and all of a sudden in 19, sales went up, 20%, and the efficiencies came with it. So they really did things correctly in 2019. So I talked to them, and 2020 is going outside of the pandemic now, of course, right? 2020 is going pretty good, and they're just moving right along. So. Yeah.
So the seller of this company really did some good work positioning it for sale in 2019, and that was the right time to sell then.
Yes, yes it was.
Right.
Yes, it was.
If they would have sold in 2018, not as rosy.
No, not as rosy. So here we have what we call our break-even analysis. So this is based off of the 2019 sales. So based off of 2019, their break even is 1.5 million. That means at 1.5 million in sales, assuming all the operating expenses stay the same, that's where they break even. That's where they make zero profit, $0,
Zero
yay.
loss though.
And zero loss, yes. But one of the things we know from that is for every dollar increase in fixed cost, sales must increase by $2.37. So if you're paying somebody X amount of dollars and they get an increase in hourly pay of $1 an hour, you have to sell $2.37 to pay for that $1 an hour increase in pay.
And that's the helpful thing with that profit goal down there.
Yes.
If they want to realize, like, let's say they want to hire another electrician, and that's going to cost them $60,000. They need to increase their profit by $60,000 to do that. Sales need to go up to 1.7 million almost.
Yeah. So this is really kind of a nice tool as you're sitting there doing kind of a what if scenario with the client, break even units. So this is really helpful as well. There's a couple more sheets, and one thing that we can do on these is we can hide and unhide sheets. Now I have hidden these two sheets. I'm going to unhide them.
You can't select them both. You're just going to have to
one at a time.
unhide one at a time.
Thank you very much. Sometimes
Sorry,
we have
that's an
those
Excel deal. Yep.
Yeah, I know.
All right.
Anyway, so this is called financial gap.
This is where we get to play.
This is where we get to play. That's right.
And run those what if scenarios for our clients, telling them,
Right.
what if you did this better?
Right. And both these sheets are intertwined. So if you do the first one, you got to look at the second one. They kind of go together. You can't just really do one. So let's say.
And remember, this is where you take those ratios from the industry standards and say, what if you were commensurate with industry standards? What would that do to your bottom line?
Yeah. And if you're wondering where some of this information comes from for our financial analysis and our financial projections that we do, two things. The Profit Master class is an excellent class, and some of this comes straight from that, this kind of thing.
Right.
And then also Economic Development Finance Professional Certification from NDC is another area where we've gotten some of this information. We took both of these and kind of put them together.
Super powerful tools.
Yeah.
Yep.
Yeah. So let's say our sales goal is, say, 2,500,000.
Yeah.
There we go. Oh, 25 million.
25 million. See, this is why we didn't just do this
Yeah.
outright all the way through, because otherwise, number one, we'd have been fixing things like that constantly.
We're recording live. Right?
I know, exactly. Right? And so yeah, we were doing that.
What was their gross margin? You remember
Could have
what
been
they were
painful.
doing? I
No,
think they were
actually,
doing,
was it 42%?
we're going to go back and just take a quick look. Their gross margin was
Super helpful.
50, we'll call it 58. Cost of goods sold 58, so gross margin is 42%, and their operating expenses about 33. Okay, so 42 and 33. So we're going to put 42% in here. Okay.
I was right. You could have trusted me.
Yes.
But I didn't remember the operating expenses.
Always check your data.
Yes, always check. Don't guess. Yeah.
Facts, nothing but the facts.
Right.
Okay, so we have 42%, 33%, and if we want to put some money in here for owner distribution, 125, we're left with, oh, how did I do that? 100,000 exactly. Cool. So at this, our days receivable are way up, and our inventory and our payables. So now what we're going to do is we're going to go over to our financial gap improved efficiencies, right? And we're going to say that our goal for receivables is, what was in this standard, 43? Okay.
Like
and if you look at this financial gap surplus, so the surplus, it sounds a little contradictory, but it's kind of the way we worked it for Excel. The surplus is in parentheses. So if they have excess cash, it's in parentheses. If they don't have enough cash, it's not in parentheses. That's kind of a hard thing to wrap your mind around, but that's the way it works, right? So if we're looking at 43 days of receivables, and let's say they're turning their inventory in days inventory. Let's say they have days inventory of only 45 days too. Okay?
Wow.
So now, yep, and let's say days payable is going to go up to 30. okay?
So
They're taking more time to pay their payables.
well, but maybe
instead
they
of
were paying them
21.
too fast,
Maybe
at 21 days.
You know, it's amazing. I tell people, I say, you don't want to pay your people, you don't want to pay your vendors late, but you want to pay them on time.
Yeah.
Because
Not
I run
early.
it, we have some very conscientious people that we work with and conscientious businesses, and they say, as soon as that bill comes in, boy, I pay it right away and I send it out. And I said, well, that's great, but that might not be the best way to run your business.
Yeah, unless of course you have net 10 with a discount of 2% or something. If you have discounts out there that you can take advantage of, do it, right? We tell our clients to do that.
Then you can do that. But to have the most amount of cash, you're going to stretch those payables as far as you can stretch them. But if you can pay your vendor in net 30, which is what the terms are, you're going to save more cash in your company, not have to borrow, and it'll be much better for you. So as we look at this through all these things that we can see here, our surplus now is $192,000. Now
different from 70,000.
Yeah.
So there's a lot more cash in the business.
And all we did was pay our payables on time.
Right.
Instead of early.
Yep.
Not late, but on time, right? So you can see how this financial gap can really help you out too in looking at things for the future. So if I'm looking at somebody who wants to buy this company, well, they're collecting in 55 days. What if I make that down to 45? Well, you can sell it right here. What happens? Now, the big assumption, you're assuming the same percentages. You're assuming that inventory is the same percentage of sales. You're assuming that payables and things are the same percentage of sales. So anyway, this is just another tool as part of the spreadsheet to help you out with this.
Really to talk through the rest of that story with your client and show them why the ratios matter. Because sometimes, okay, well, that's what the industry is. And, I don't follow industry standards. That's great.
Right.
But if you did,
yes,
or outperform it, here's what would happen for you. And those what if scenarios for clients are really, really super helpful when they're looking at expanding, growing, adding capacity, doing something different.
So whether you're looking at a company or a client that is looking to purchase a company, maybe they have an existing company that's been around for a while. They're trying to figure out where their cash is or really kind of analyze it a little bit further. Or maybe you're trying to prepare this for the bank so a bank can get a good analysis of what's happening. This spreadsheet will work for all of that. One of the things I have done as well, of course, you're going to have these for free and you can open them up and do what you want. I've changed this into a quarterly as well. And I do have a client that I work with where I do this quarterly for him and give him some percentages as that as well. And I'll let you figure that spreadsheet out yourself for quarterly, but you can do whatever you want with it. So
right. And sometimes your clients do want a little bit more granular analysis throughout a year, especially if they're making some big improvements or doing some different things. They want to see it a little bit more granular. You can change this to month by month if you wanted to. But that's a little bit too granular for most of these changes and percentages to really make a lot of sense.
I just want to thank you a lot for coming to Historical Financial Analysis and taking a look at this with us. I hope that this tool can help you out and that you'll be able to use that for whatever you want and help you out with your clients.
Right. And we just think that these tools are helpful and powerful for our clients, and that's why we present them at ASBDC. And so hopefully you'll find the same. And we greatly appreciate you taking the time to sit with us for about an hour.
So thanks for virtually coming.
Yeah. Enjoy the rest of the conference.